You're listening to the Business and BBQ Podcast, hosted by Tim Harridge. Tim Harridge is an active entrepreneur who built and sold 6 companies by the age of 40 and enjoys sharing the ups and downs of business and entrepreneur life. As for the barbecue, that's just something he has a passion for and likes to share as well. Here's your host, Tim Harridge.
Tax strategies and colluding with a Russian. Oh, man. All right, everybody. Welcome to this episode of the Business and BBQ Podcast. This episode has come about because a couple weeks ago, we ran a Facebook poll in the Business and BBQ Podcast Facebook group and just said, hey, entrepreneurs, what are you interested in, right? And the number one thing was marketing. So we knocked out marketing that week. And to my surprise, the number 2 thing was tax strategies. And
you expected it to be number 1?
Well, a lot of times entrepreneurs aren't worried about their taxes, Michael, until it's too late, right? And I'm sure you'll say a lot about that. But a lot of times entrepreneurs really do focus on marketing and sales and products and all of this stuff while they leak away all their profits. But I'll get ahead of myself. When I saw the result, I said, okay, who can we have? And within the real estate investment industry, there's really no one that's recommended as much as Michael Plaks down in Houston. So we connected. We have Michael on the podcast today. Michael, say hello.
Hey, hello, everybody. And in case you haven't run across me yet, I'm Michael Plaks, and I'm known as Black Belt in Real Estate Taxation. So here I am, in all of mine, there is black belt. There are my sparring gloves because somebody has to punch out Uncle Sam, and that's my job. So here we are. Okay, I've been in this business for 20 years, known Tim for 10 years, I believe, or so, and let's roll. Okay.
All right. So, as an entrepreneur, someone that is involved in, I have some investments, I have a home office, I have not a home office, I have active real estate dealings, I have passive real estate funds I'm in, I have businesses I've invested in that have nothing to do with real estate where I use my IRA. I think, there's so many different rabbit holes we could go down. Just if you could, Michael, tell the audience a little bit about you and your specialty. And then I really want to spend the next 20 to 30 minutes talking about kind of that top 5 to 10 things that you see people wasting money on, because it's my belief, and this is my new philosophy in business. And you've known me from times when I was trying to start global enterprises to times that I was just wholesaling houses. And it's my philosophy now at the ripe old age of 41 that if I had just worked a little smarter and kept more, I'd have been a much happier guy. And keeping more has to do with, Uncle Sam and Aunt Iris taking all your money. So talk a little bit about yourself, what you do, and then, kind of 5 to 10 things that you see a lot of entrepreneurs and real estate professionals making big mistakes on.
Okay. Tim, honestly, I don't want to talk much about myself. I'm probably the least interesting part of the podcast.
I don't know. I mean, you look pretty interesting to me.
Well, except for my, East Texas accent, other than that, just a boring accountant dealing with real estate. But since my business is exclusively working with real estate people,
right?
There are very few people who can claim that nationwide, and we work with real estate investors only. And 20 plus years, so I have seen thousands of investors in all stages. Some of them we watched growing from zero to big boys, and some we watched going from big boys to zero. So we know what works. We know what works, what does not work. Yes, so I have a lot of observations, and I also have a lot of opinions. So I have some very strong opinions, and I don't care if somebody disagrees. I'm old enough to not care. So I'll gladly share my opinions. And my first one is people confuse 2 things. Like which to me, the starting point about when we talk about real estate investments. People confuse income and with wealth. Okay, income and wealth are two completely different things. And when people saying is I'm real estate investor, and you ask, what are you doing? I'm a wholesaler. God, like, it's good to be a wholesaler, but you are not an investor. Okay, I want to be very clear about, again, my opinion, everybody has an opinion. We are online, everybody can disagree and everybody will disagree. But my opinion is this, okay, investor is somebody who owns property, okay? And owns property long-term. This is what investment is. You put money in and you wait for that, and you wait for your money to work. Everything else is a job. Being a wholesaler is a job. Being a flipper is a job. And it's necessary for income, right? If you lost your job, if you need money to pay your rent, yes, you need to do something. Wholesaling is the natural thing to do, but that's just a job. Why is it a job? Very simple test, guys. What happens if you stop doing it for 3 months? What happens? Your savings run out, you're broke. Okay, so what happens with flipping after you sold your flip? Okay, cashed your check, mandatory, posted on the Facebook, everybody put 55 likes per minute, that yes, you just cashed the check. Wonderful. What happens 3 months later after you spend all of this money? So that's a job. You have to keep doing that. So when we talk about, and it's job and it's producing income, good income, maybe more fun income than sitting in a cubicle, but it's still job with income. What you need, ultimately, if you are building wealth, is something that works for you and you don't. And historically, there are only two things you can do. You can buy real estate or you can buy businesses. Either real estate or businesses. People say, like, you can buy securities like stocks. Yeah, but stocks own real estate or businesses underneath.
Right.
You either own real estate or you own businesses. We are in real estate world, so yes, you buy real estate. So when we talk about investment and long-term strategy, the strategy is acquire real estate and keep it. As simple as that. Now, people I'll continue being opinionated because people love to bring notes into conversation. It's so popular right now. Owner financing, notes, and stuff is okay. Guys, notes is not wealth either. It's income, but not wealth. Here is why. Okay. Nothing wrong with notes. I'm all for notes. Great way to make income. But right after the note is paid off, you have nothing. There is no income. There is no asset. Absolutely nothing. And you can have a great cash flow, but you have to continue to acquire notes all the time. Notes does not grow. Notes are depreciating assets. They reduce from the time you bought it to zero eventually.
So it's a declining income stream with a declining asset base.
Right.
Every month you make less interest and you have less of a note receivable.
Correct. So the only real asset, the only real long-term growth is own real estate. Now, what is that? That's like everybody's preference. You can own mobile homes, you can own single-family homes, apartment complexes, commercial buildings, storage facilities, Airbnbs, whatever. But you have to own something that will consistently generate cash when you're not doing that. So when people talk about long-term wealth is how do you, maybe right now you're not in a position to do that. Maybe right now you have to feed your family, have to do wholesaling, fine. But your strategy has to be built around as soon as possible getting to the point where you can acquire and keep properties.
Right.
Okay. And I saw you, doing yes when I mentioned notes. So, okay, you and I apparently are in the minority here, right, Tim?
Well, I think it comes from experience, right? So, in 2008 and 2009, when the market was kind of in the toilet, I owner financed a lot of properties. And I said this in one of my episodes. I'll never forget, it was October of 2017, and I did my balance sheet in my property, my property schedule for my bank. And I got really excited, right? Because values were way up, my pay down was way down. And I run down the hall and I show it to Jennifer and I'm like, look how much we're worth. And she's like, wow, right? And I was like, wait, I got to take the notes out because we don't get the difference between what we owe on the underlying lien and what it's worth. I got to go figure out what those people owe me. And so like that little correction lowered my net worth by almost $2 million. And it's like, then you start looking at it, and we were about 8-9 years into the note. So we had sucked almost all the income out of it. The payments were about to become all principal. So we sold all of the notes and then reinvested into rental properties because so when you said that and I got all like excited, it was because I went through that revelation on my own, right? I mean, I had to kind of figure it out, and I'm not opposed to notes. I bought some notes a couple months ago, right? That were a distressed note sale from a seller. We bought them for 50% of the unpaid balance. It's good income. I had a house last month that I bought it for $100,000 and owner financed it as is for $140,000 and got 9%. And it's great. It's a great income play on a house that didn't fit my rental strategy. So it's one of those things like I love doing it, but it's not investment. It's not long-term wealth.
Correct. Okay. I'm happy to hear that we are on the same page as we usually are.
Right.
You know, when we talk.
Well,
Okay.
experience is a great alignment tool, right? Once you've made enough mistakes, you can kind of like, you're typically on the same level with other people that have been doing it for 20, 30 years, you know?
Well, let's continue opinions, I guess. Okay.
I love your opinions.
Okay. Next opinion. Okay. Different topic. Okay. Not talking about income wealth now, switching topics. People talk about taxes. Well, I'm a tax guy, so right. Of course, taxes, everything. Here is what I'm against. Yes. When people, first thing they start discussing is about tax benefits of real estate. Okay. I'm buying real estate because of tax benefits. This is number 3 consideration. Way below number 1 and number 2. Okay. When you buy real estate, you buy it for 2 things. And the first 2 you can put in either order, you know, whatever you like. It's cash flow and appreciation. You buy it for cash flow, you buy it for appreciation, preferably both. I know successful investors who focus only on one of the sides, like focus on appreciation or on cash flow and ignore the other side. Ideally, of course, you have both. But tax benefits is the distant third. It's nice to have it, but it's the icing on the cake. It's not the cake. And people so many times I'm saying is like, oh, like when we talk about something and realize somebody is not in a position to benefit in his particular financial situation. And I get people is, then why did I buy that? And they sell it and like, what are you doing? You know, you did not buy it for taxes. You bought it to become wealthy. Yes, Tim, you wanted to say something.
It's kind of like when I sit at a restaurant or a happy hour and someone will buy me a drink and say, don't worry, it's a write-off. And I'm like, I don't know. I mean, I've done it when I was young, trying to act cool for my friends that are, oh, I'll buy, don't worry, I can write this off as business. And it's like, that's not the reason to spend money, you know?
No, it's very simple. We'll talk about, if it's a write-off, let's reframe that. What happens when it's a write-off, it's not free. Like somehow people be, it's write-off, it's not free. It's not free, it's a discounted thing. So what happens if you bought something for $100, you wrote off of taxes, maybe you saved yourself $30 on taxes. So you ended up paying 70 instead of 100. Okay, you bought it at a discount, it's still not free.
Right.
So people are saying is, what else can I spend money on so I get more tax deduction? And like as simple as we have this, you only buy what you need. You only spend money on what you need to spend money. Never pay anything just to get a tax deduction. Okay. So we talk, like I mentioned, so it's a distant third,
right,
to get tax benefits from real estate. Let's like briefly outline. So what are the tax benefits of real estate? But before talking about that, momentarily I will loop back to that income versus wealth discussion. If you are in the income part of real estate, if you are wholesaling, if you are flipping, there are no tax benefits. That income part not only does not create wealth, it does not produce tax benefits. You make money the hard way by working hard, and you pay taxes on top of that, and high taxes usually. We have strategies to minimize them, but there are not tax benefits, there are extra taxes. If you're on the wealth side, not only you are building long-term wealth by investing in rental properties, but here you have benefits. So briefly, what those benefits are. So number one, you can have, remember like what the reasons are. We have cash flow and appreciation. So cash flow, you can have cash flow without extra taxes. Now that sounds strange, but that's how it works very often. You can have rental property, you generate 1,000 rent per month, and your carrying costs, everything included is 800, so you have that 200 positive cash flow per month. But when you file your taxes, it shows that you have no money or you have zero. Why? Because of depreciation and all those techniques that we do. But in reality, in no other business can you, well, I'll take it back. There are a couple other businesses like oil and gas where it can work that way. So you can, but real estate is the most common business where you can have cash flow without increasing your taxes. So that's clearly benefit number one. Benefit number two, we say appreciation is the second goal of owning real estate. Appreciation means you make more money. When you make more money, you usually pay taxes eventually when you make that money, which is when you sell. In real estate, we have strategies when you can sell, but not pay taxes on that capital gain. So that's like second benefit. You can defer it into the future. Sometimes you can avoid it completely. There are different strategies dealing with that. Third one is, as the property grows in value, you can pull cash out of that. You can pull equity and refinance, like do cash refi, and you won't have to pay taxes on that. That's not a magic rule. You know, eventually it will cost you more taxes at the end of the deal, but maybe not. Again, if you combine different strategies, you can have the ultimate strategy, and I will describe the ultimate strategy, which everybody in real estate, you know, should at least consider doing. Here is the ultimate strategy: is you get your first property, let it appreciate, then you do an exchange, a 1031 exchange, from that property into a bigger property, from that one into even a bigger property, even bigger, and then eventually you own huge property and you die with it. And then that property goes to your children, tax-free, and that capital gain completely erased. That's your ultimate tax planning, and a lot of people are actually doing that. And then, of course, you have self-directed IRAs and all kinds of other strategies that are not specific to real estate, but are commonly used in real estate to accelerate your wealth building. What's your favorite team?
Now, you said on like a rental property, if you refinance it, you can pull the cash out without paying taxes on the cash out. But you said ultimately it costs you more. Why is that? Okay.
Well, here is what happens. And the only time where you would not worry about that if you are using 1031 exchanges. But let's take an example. Okay, so you bought property for 100 grand and you have a 75,000 loan on it. Okay, so after a few years, the property value went up to 150, you refi it at 100. So you had 75 loan, you refied it at 100, pulled out 25 in cash. At that point, there are no tax consequences. None. You don't have any you don't pay any taxes because you pulled that 25 out. But what happens here, and that confuses people a lot. Let's say you sell this property the next year. You sell it at 150, you know, same price, let's to simplify the example. And now you have 100 grand loan on that. You pay off the loan and you believe, oh, I only made 50. But what happened is at that point, that 25 that you pulled out is added to your capital gain. Now, my example is not really accurate from technical, I'm trying to translate taxation, into beginner investor terms.
Yeah, so you're talking more like a common misconception, right? People, they think that that 25,000 like makes it where they made less in the deal, but it doesn't.
Right. if when you sell a property, what will end up is you will pay taxes on that 25 when you sell the property. And people get upset because they're saying, I did not bring that much cash from the closing. Why? Oh, well, because a few years ago when you refied, you pulled 25 tax-free back then. Right now it's time to pay for that. Time to catch up. Well,
so if you never sell the house
and 1031 it, yes, then you don't worry about that. Absolutely.
So it's kind of funny you talk about that. My goal when I was
yes, I talk funny. I agree, Tim.
Was to have a lot of free and clear houses. Like I used to think I really want to own these things free and clear. I don't want to owe anything. And after I did my time with Blackstone and I talked to this billionaire friend of mine, his whole thing was like, Tim, that's completely wrong. You don't ever want to pay off a house. Leverage it to the hilt. Get as much low interest responsible money as you can, because he's like, that's tax free. He said, what you don't want to do is ever sell a house. So now as I sit here a lot more experienced, I'm thinking, I told my wife this, I want to get to 40, 50 really quality appreciating, primo houses. I used to buy the $80,000, $100,000 houses. And now most of my houses are 220 to 300. They're really, really nice houses. And I told her, I said, look, if we refinance, the number was 40. I wanted to have 40 houses. And I thought every 20 years I'd refinance a house, or every house would get refinanced every 20 years. Because I'm like, then I'm always paying interest, right, which comes off the top line. I run out of depreciation, around year 27 and a half. But you're always able to kind of recapitalize the business in a tax-free manner. Is kind of my idea.
Okay.
That's my opinion.
I'll just insert one technical correction here, because when you refi, depreciation does not change.
Right.
You won't have new depreciation, right, because of that. But yes, there are different schools of thought, and that's like general financial concept. It has nothing to do with taxes. Whether you leverage to the max or whether you keep your equity high, that is debatable. People, it's like religion. It's like Ford against Chevy. Which truck is better? You will forever argue about that. You will have people making arguments both ways. I'm in the leverage school of thought, but I acknowledge that people who talk about keeping equity high and leverage small have their points too.
Right. So as you look at entrepreneurs in general, right? I mean, as you look at small business owners, and I know a lot of these investors have multiple businesses, right? Like
Yes.
Take a guy like me. I mean, Lord, this time 2 years ago, I was signing, not just filing. I was the signer on 8 different returns. And I was a part of, I got a flat. And I was a part of probably another 4 or 5 returns that I was just getting a K1 from. Mm-hmm. So what do you see that people could do? I mean, do you think that it's more important to start right or just course correct as you start to grow?
It's very important to start right. If I only knew how to start right. It's just, I did not start right in my business. Okay. Right. Like it took me years and what you call like course correction all the time. That's what our life is. That's the way we deal with careers, personal relationships, businesses. Everything is like that. I think the key is to start. If you focus how to start right, you will never start anything.
So let's talk about starting, because there's a lot of new entrepreneurs. There's a lot of business owners that I do business with that are getting paid in their personal name. They come put a fence in my backyard and they run I'll use the bobcat. They come use their machinery to move the dirt in my backyard, and then they get paid they want me to write them a check in their personal name. Right. I always think that's a bad idea. because of self-employment tax and all that. If you're starting a new business, what's like a basic, do you recommend like just a single member LLC, which by the way, I had one guy tell me that that's like the number one audited thing because it goes through on your Schedule C, or do you recommend someone form a partnership with just another friend? That way it's a K1, and just imagine a small budget service business. How do you recommend someone start a little right?
Okay. Small time business when you start is what I say, I have opinions. Okay. Again, my opinion is you don't do anything.
Okay.
When you start, you focus on making money. That's the only thing you should focus on when you start. Once you made money, then we need to think about how to set up your business. This is why I'm saying that. It's very briefly, and it sounds counter, to common conception that everybody talks about how you need to start different structures, asset protection, tax benefits, all of that. Is first, asset protection is not my department. That's for attorneys. And attorneys always disagree about that. I'm one of the top contributors to Tax and Legal Forum on Bigger Pockets. And I'm very active on Facebook groups related to tax and legal stuff. I even founded our own group like REI Tax and Legal Wizards. And every time there is a conversation like that on Facebook, at real estate clubs, on Bigger Pockets, everywhere, attorneys completely disagree. Attorneys joke, and it's not really a joke. They say, ask two attorneys, get 3 opinions. With asset protection, that's a rule.
Right.
So I cannot step in that at all because I'm not an attorney, right? So if your attorney says you need to set up something for legal protection, sure, that's his job to protect you. But one of my favorite attorney friends has a saying which I love to quote. He says, clients who come to me for asset protection do not have asset protection problem. They have asset accumulation problem. So to me, it's okay, accumulate assets first, worry later.
No, I agree, right? Because I tell people all the time that they get tied up in a series LLC or a limited partnership or this or that. And my opinion is just always, I tell people, if you have enough money where that's an important question, then you have enough money to hire an attorney to give you the answer.
Yes.
Right. And
I agree.
But with a sole proprietor, what I'm trying to say is, here, I'll give you a good example. You've probably seen this 100 times. This is my accounting paperwork for the week.
Perfect.
Right? I was on vacation last week, right? So, but every one of those, all of this is separated into separate companies and separate this and that. It does not, the output is not that organized. But I see a lot of small entrepreneurs that could at least go set up another personal checking account for their business.
Yes.
Where at least they can keep it separate. So talk about record keeping. I see so many people they don't. I asked a guy the other day that I was looking at investing in his company, and I said, well, where are your corporate books? Oh, I don't have an accountant. I'm like, well, dude, you don't need an accountant. Do you have an Excel spreadsheet? Do you have Quicken or QuickBooks? Or, I guess what I'm saying is let's avoid the legal opinions. How can one organize their business to make it where when it is time to come to you, when it is time to figure out how much they really made, what are some quick tips that are there any apps out there you see people using to track their mileage? Any ideas or something you could share?
Sure, of course. Okay. But I'll return to a question in a second. I just want, before I forget them, insert something here because you were talking about, we started talking about entities and setup, right? And I said, everybody, when they ask me a question, what's the best strategy, they assume that I'm going to tell them something about forming an S Corp, forming some kind of complicated entity, setting up sophisticated entity structure and loopholes. But really, where the most potential is keeping good records. But something that you just started talking about, Tim. And it's boring. It's so not sexy to talk about bookkeeping. It's like one of the most boring things you can invent, to talk about other than tax code and politics. Well, politics.
Politics has gotten kind of exciting lately.
Oh, yeah. Yeah. Anyway, so that's where the greatest potential is, because where we have problem is people come to us and saying is, okay, I need to prepare taxes. How much you spend on that rehab? Like, where are you there? Oh, I don't know. Like, I think I spend about 25 grand. What does it mean about? And first, when somebody says 25, it never means they spend 20. Because, we tend to cheat, to fool ourselves by pretending that we did better. So if somebody says about 25, probably he spent 35. But if you only have receipts for 25, he is throwing away 10,000 worth of deductions. 10,000 worth of deductions, he is throwing away like 3-4 grand of actual cash, like of tax savings that he could have received. And we're throwing away thousands, and then people talk about corporations, like, forget corporations, get your ducks in a row first.
Right.
Get your simple things. So he said, how do you set up? It's okay. I prefer simplicity. I call myself lazy accountant. I don't want to do more work than I have to, and I don't want my clients to do more work than is necessary. So what is necessary is, first time you set up, start by creating different account at your bank. Go to your bank, open different account. Doesn't even have to be a business account. Could be another personal account, but use it exclusively for business. And get into a very simple but very important habit. Everything related to business, you pay only out of the business account. So if a business account is empty, people saying is like, we have clients and they come to us and they have 12 mortgage payments. We look at the bank statements, there are 10 of them. Where are the other 2? Oh, there were 2 months when I didn't have cash in my business account, so I paid it out of personal. Dude, it's just a 2-step process. Move money from personal account into business and pay it from business.
Right.
Also is like, you made some money, you closed on a deal, you want to put down payment on your new car. Great. Again, 2-step. Move it from business account into personal and write it, check to the dealership from your personal account. And then you can, of course, post yourself next to your new car on Facebook so everybody knows you really are successful, because how else you can prove it, So, yes, so number one habit is absolutely like start creating account and create a habit of paying that. Habit number 2, stop using cash. Don't pay anything in cash. Avoid cash. People saying as well, those people don't take checks, like don't take credit cards. Come on, everybody can use PayPal these days. There are electronic ways to pay people. Like you have to find like really the only people who would, who you would have to pay cash is like Home Depot parking lot people. But I have a problem with hiring these people anyway. Like I don't recommend you use them no matter how cheap they are. And that's a different conversation though. Anyway, so avoid doing cash. Third one is start using app. Like people before said, yes, I have shoebox, I'm throwing my receipts because I don't know how to use QuickBooks. You don't need QuickBooks when you start, okay? Use something simple. Like you, Tim, mentioned, okay, spreadsheet, fine, but spreadsheet still requires, some computer skills. There are so many simple applications. Google, put in Google, really, best apps for expense tracking. Like what people use, okay, there is one called Expensify, okay. I'm not saying it's the best, it's one of the most popular. Like if you want just one, use Expensify, okay. You want to use like there's like QuickBooks for self-employed application. It has receipt tracking and mileage tracking built into that. Want just mileage tracking, there is an app called Mile IQ. A lot of people use Mile IQ. Like there are so many apps, it's so easy to use that right now, really there is no excuse to not do that. You just take your phone, snap a picture of your receipt, or like you look at your route anyway, where you are going. So just when you get on the road, tap it once, it starts recording, and when you arrive, tap it second time, and it created that log for you. Log that Uncle Sam is asking everybody to show when you get audited. That's his first question. Show me your mileage log. And people say, I didn't keep it. I cannot understand why anymore. Like 10 years ago, I could understand. 10 years ago, our most popular product was, I still have it, just lazy to get up from my desk and bring it to show, like printed log books, like where people could write, their expenses and mileage. And people complained it's too much work. But right now, everything is on your phone. So, those three things: create separate account, avoid using cash, and start using apps for tracking expenses and receipts. Now, once you go to the next step, once you start owning properties and doing flips and real estate rentals, now then I have bad news for you, because bookkeeping at that level is extremely complicated. Extremely complicated to the point where even if you hire professional bookkeepers, unless they are real estate specialty bookkeepers, they don't know how to do it right. So for years, we struggled with that. We tried to find bookkeeping partners. We tried to hire people to do that, like find different like outsourced solutions. We ended up creating in our firm our own proprietary bookkeeping system on which we put our clients, which is specific for real estate. You don't need it until you own properties, but when you do, that's one of the greatest, lifesavers that we can offer people. We have people, when we first time train them in our system, like, response is always when Harry meets Sally, and it was like, oh, like finally, like, yes, finally I can do things in a reasonable way, because what we do is, the hardest part is to enter sales, refis, and purchases from closing statements. So we do it for our people ourselves. The rest is automatically pulled from your credit card and bank statements and automated for you. So it's like excellent system, and but that's what we had to do for real estate investors who are at professional level. But when you just start, use any app, and and get into a habit of recording everything.
So let's say that I am and I run, you make a lot of money, and I want to start buying some.
What do you mean, let's say? You do make a lot of money.
Well, but I'm not a plumber. And let's just say that I wanted to buy a rental property. Should I buy that rental property in my plumbing company? Should I buy it in my personal name? Or should I go create a new LLC?
Before I answer, I have to take a minute detour. You said plumber who makes a lot of money, and you are talking to me. So I have to tell that old joke, which is just like, it said the CPA calls a plumber, and like after 15 minutes of fixing something, plumber hands him a bill like for $300, and CPA looks at it, and I'm saying is like, wow, I'm a CPA, and and I charge less than you do. And he said, I charged less when I was a CPA too. Okay, so what that plumber should do, you're asking is whether he should buy rental property in his own name or name of a company. Okay. Again, there are two aspects, legal and taxes. For legal, that's question to his attorney. His attorney will probably tell him that for legal protection, he needs an LLC. On my end, for taxes, it does not matter. That's what surprises people, but I'm trying to explain that. Okay, when you have rental property, LLC does not do anything for you on taxes. There are no extra deductions. There is no new tax benefits. You don't save on taxes anything. The result is exactly the same. In fact, the most common situation, if it's just you, if it's you team, or like you and Jennifer, like whatever, like husband and wife, LLC, you won't even see it on your tax return. You have it for legal protection, but on your taxes, it will look exactly the same as before LLC, with or without, the same result. But people say, well, I can put it in a separate company and treat it as a partnership. Fine, but at the end of the day, the result again is exactly the same. Nothing changes. with rentals. If you want to address your taxes with entities, that's the game that is played by people like plumber. You think, okay, a plumber who makes a lot of money in your example. Plumber can benefit from a corporate structure. You can possibly create an S Corp and he can save on self-employment tax. If he really makes a lot of money, he can maybe create a C Corp and save on taxes even more. But that is for people who have what we call active income. In real estate world, it's realtors, wholesalers, flippers. Those people, when they make enough money, may need a structure. What I hate is when people give that, one rule, they're saying is everybody should do that. They say there is a rule of thumb. Can we see your thumb? Yeah, exactly. Like, what happened to your thumb?
I cut it with a knife. I like to cook a lot.
I was just saying the rule of thumb today for Tim is just perfect illustration. Tim has a special thumb today. So rule of Tim's thumb would be like, okay, everybody creates an S Corp. It's bull. Not everybody creates an S Corp, even if you are a flipper or wholesaler, because S Corp helps people only in specific circumstances. And more so, in some circumstances, S Corp can hurt you and cause you to pay more taxes. And people are shocked by that, but that's the case. So you never say everybody creates an S Corp. You create a S Corp in certain situations. So for some people, it will help. For others, it won't. But if you are doing rentals, it will never help reduce your taxes. So for rentals, you have other tax strategies, but not entities. And by the way, you never buy rentals in corporate structures. Not S Corp, not C Corp. They are wrong structures to hold rentals.
So, I was talking last week or on Friday. I was on my way back from Jamaica, and I put a post of a check a wire I just received an email about. It got $23,000 in.
Did you say it was a pic of a check or a check?
Check.
Oh, okay.
But it wasn't a check. It was a wire I received. So, which I don't understand why people get $100,000 checks anymore, by the way, but that's a whole nother conversation. And it's the first check I've ever posted, but I posted it for a very specific reason, not to brag, but to actually talk about how bad it was to get a $23,000 check. Because in the post, I broke it down. And I'm gonna find it real quick, because I know that you and I have crossed some people on Facebook that were posting a bunch of checks, and it just means nothing. Yeah, come on, pull up. I want to show. I don't think you saw this. It was Friday, late Friday. Said, I'm posting this check. I just closed a super complicated estate deal where my gross assignment was $40,000. And I talk about, I wanted to keep it, but I had to sell the house because the company needed operating capital. And so by the time I pay my overhead, my advertising, because I allocate everything kind of on a per deal basis and account for everything, I make about $16,000 before taxes. And I estimate it's about $11,000 after taxes. And when you look at it, that deal, had I kept it, I would have been out of pocket about $25,000, $30,000, but I probably would have made $12,000 the first year, and then $12,000 the next year, and then $12,000 the next year, and then $12,000 the next year. So I bring that up because I think the real estate investing industry has to do a better job about educating themselves on the devastating impacts of running a dealer business, of getting on that treadmill of advertise, pay salespeople, pay office, pay expenses, cash a big check. And, I'm kind of looking at this, and I'm estimating the last 2 years, my wholesaling business has only run about a 20% net margin after taxes. And that's probably maybe even a little high. It may be about 15 to 18% net margin after taxes. we're probably running a 30% EBITDA, right? Earnings before interest, taxes, and appreciation.
Tim, I just have to interrupt you.
Go ahead.
Oh, just have to tell you. If you had a real bookkeeping system, you wouldn't be saying probably.
But I don't. Well, I say that because I'm one of those, I say this all the time on my podcast. I'm an entrepreneur that is more than happy sharing that I do a lot of things wrong. And one of the reasons we've sold some companies recently is to clean up the messes. We sell these companies and you cash in and you're able to clean up your balance sheets enough to where you kind of keep what you want to keep. And even now I'm down to 4 tax returns. No, 6, 7 if you count my personal. And but by the end of this year, I'll be down to 3. And so, yeah, you're right. I mean, I should definitely know my margins better. And I don't, because that business, that wholesaling business, has so many other things in it that were set up wrong. Sometimes literally when I'm entering an expense, it's just a guess. It's like, yeah, I think that expense was for, I don't know, that domain name over there. Sure, why not? But no, so I bring that up because, knowing your margins, right? On this deal specifically, I paid probably, I don't know. I probably paid about 25% on cost of goods sold for labor and a sales and acquisitions people. I probably paid 25 to 30% of the income in advertise. Well, it was about 20% in advertising, about 10% in overhead. And I always look at these numbers on a quarterly basis. I just don't know where we're at right now because I just got home from vacation. I've got a lot of Jamaican beer running around in my head still. And then, I pay myself a percentage of all the gross personally because, you got to pay for private school, right? Not for me, for my kids. But yeah, so like when I started kind of digesting it, it's one of the reasons I'm really shifting a lot of my focus right now to spending my talents and my energy more on my rental portfolio and less on my events and wholesaling and real estate brokerage and loan company and insurance company and all this other stupid stuff I have, because if you can increase those margins, you can do less. You can actually enjoy the fruits of your labor, right? If you can just, it's like I tell everyone, if you're trying to make 50 G's a month and you can operate on a 50% margin, well, okay, you only got to do 100 grand in gross, right? But if you can get that up to 80%, now you only got to do 70,000, or 65,000. So it's kind of one of those, like, I'm personally working on that better. Like what you just said, I'm personally trying to understand my margins and my expenses and fix them to where the business is much more sustainable, which I think then makes my life more enjoyable. So, I think that's a good segue to, let's talk about what your firm can do for I think you said earlier, you only work with real estate investors. But so if there's any real estate investors listening to this, what all can your firm do for them?
Well, we can prevent people from becoming Tim Heritage, publicly complaining about not knowing his margins and starting businesses that he has to close because of margins and profitability issues. But okay, on a more serious note, though is our experience has shown that the bigger the operation is, usually the messier it is on the internal situations. Like if you start feeling is like, yeah, like I spent 20 years in business, and should know better why mine, is not still taken care of. Well, because you have a big business. And our observation over the years is literally the biggest investors have the worst mess. And some of our testimonials came from, pretty big, well-known investors who tell us that when they came to us first time, it was complete mess. And to a point is like that. What does it mean mess? Okay, like I just had bad books. No, you didn't have bad books. Those bad books cost people sometimes in 3 digits in taxes, like up to 100 grand of unnecessary taxes that on a big enough operation they were paying because they did not know what they were doing, didn't have strategies. And not having books creates even things when one of the big investors, when started the first year and we asking, exchanging emails with their bookkeepers and asking us, what is like this $65,000 item? We cannot like link it to anything. They started looking and figured out it actually was embezzled. So like things like that happen, when your house is not in order. We have, It's like real people, real stories. And when we started, our company was doing tax preparation, like basically, we are still called REI Tax Firm, like Real Estate Investment Tax Firm. Oh, by the way, anybody wants to find it, it's reitaxfirm.com. Very easy to find us. But we don't do tax preparation by itself anymore. Because what we found is the real problem is not taxes. Taxes is the last step. The real problem is keeping things structured, orderly, and organized, where you know your margins every minute, where you know where your weak points are, where you know where you are making the most money, and you can adjust. We talked earlier about how do you do things the right way from the beginning, or do you change your course as you go? You always change your course, but you want to know where to change your course, like need some data. You cannot adjust where you are going if your GPS is off, if you don't know where you are. So what we do is we have all of our clients right now, our annual advisory programs, which includes everything. We obviously we do their taxes, but more importantly, we set them up with good bookkeeping system. We have regular quarterly meetings, strategy sessions, where we discuss, where we analyze financials, where we help them advance their business, where they have good picture of what happens with their business, how much taxes they owe. Of course, we offer all the loopholes and strategies that exist there. We help dealing with this guy. So if they ever receive any letters or God forbid have to be audited, well, we're here with the red gloves so we can punch Uncle Sam out and defend our people. So here is what we do, like basically all-inclusive tax advisory and financial support for investors. And since we spent 20 years in that business, we speak your language. We have people like, and not just me, like my staff, we have clients, they come talk to my people and they start explaining, and doing, and my, like people saying, okay, so you do wholesaling? Oh, you know what I do? Of course we do, like, dude, like, that's our business. We know what you are doing. And it's funny, sometimes I post on Facebook and occasionally it deals with issues like construction and people saying is like, how do you know that? You're a tax guy. I'm like, no, I'm a real estate tax guy. I know things. I know things about real estate, and our biggest thing is, okay, just recently we took, there was an interesting conversation. We were talking with a new client who is first year with us, pretty big operation. And we quoted them our service. And then once they signed up, they said, it's like, look, I talked to my wife, says the guy, the business owner, and he says, like, we discussed it and we looked at the number, like how much is your annual service cost? And we asked ourselves a number, do we expect that we will get back 10 times what you are charging us? And we looked at it and we said, we believe we will. I was like, oh, well, great pressure for me expectation-wise, but that's what we are really trying to do. We're trying to bring value to people's businesses, tangible value, which comes from having control of your financials. And of course, minimizing your taxes is part of that. Absolutely.
So Michael, I really appreciate you being on today, but I have one more thing I have to talk to you about.
Go.
Do you like barbecue?
Ah, damn. I was afraid it's going to come to that. You know, I'm Russian, not Texan, right? I like barbecue, but can't tell you much about that. See, unlike you, I cannot really I would lie to you if you blind a test on me, you know, plates from a famous place and from Walmart, you know, I probably won't be able to tell you.
Well, we're going to have to get you up here to Dallas, or I'll have to come down to Houston, and I'll take you to experience. What we'll do is we'll go to Dickey's Barbecue, and you'll see what barbecue is not supposed to be. And then we'll take you to a good barbecue place, and we'll show you what it's supposed to be. And then you'll know the difference. But so I've been to Russia. I spent time in Vladivostok when I was in the Marine Corps. We were doing some playground stuff, and it was the first time I ever really drank vodka until I could not see straight anymore. I'll never forget, you know, we were just sitting there at the table with the Russian military, and comrade, another vodka. And before you know it, you know, all the Marines are like seeing double. So I hear you. There was, in Vladivostok, Russia, there was no barbecue for sale.
No, there is no barbecue. But one thing I can talk about barbecue is this. Will be maybe another tax tip in barbecue. Barbecue is actually a good example. Question is, can you write off barbecue? Want to talk about that?
Yeah.
The answer is, if you structure it properly, you might. Here is a question would be, okay, what do you use barbecue for? And let's imagine that you host regular barbecue gatherings for your investors, business partners, employees. So what you need for that is you need pretty nice grill. You know, you may need to have a setup. You need to buy meats and everything else, and booze, of course, you know, to have done it. And if you can have a legitimate business purpose, you might be able to do that. But it has to be like treated as business setting and done in a business-like fashion. If you will have to show, if I need to go and fight Uncle Sam on your behalf over that, you know, we need to show them the frequency. We need to show them pictures. We need to identify, look at all of these pictures. See who is here around barbecue. You know, it's not his family. You know, this guy is his business partner. This guy is his private lender. This guy is his student. This guy is his tax accountant. Here on the picture. Okay, so that's...
So, you know, I guess you just touched on the whole reason I started this podcast was so I could go do some taste barbecue and talk about it in a business setting. Yes. My brother just commented on Facebook. He says they have a good barbecue spot in St. Petersburg.
Really?
That's what he said. Yeah, because he went over.
I am from St. Petersburg. You know, back when I was there were no barbecue places.
The world's changing, Michael. The world's changing.
Really?
All right. Hey, man, REI Tax Firm.com, like real estate investor, taxfirm.com. Is there a phone number people can call?
Yes, but it's better to go through the website. You will get, the number is 713-721-3321. But I would still recommend visit the website first, you know, on your phone or on your computer. You will get an idea of what we do, and you can contact us through the website. You know, Of course, you can call, you know, but the fastest response will be going through the website.
All right. Well, Michael, again, thank you for being on the show. We'll get you up here to get some barbecue here soon.
Sounds like a plan, team.
For everybody listening or watching, we're out of time. Until next time, keep cooking.
Thanks for listening to the Business and BBQ Podcast. Make sure you check out our other episodes and stop by timherridge.com to say hi. We want to hear from you. Until next time, keep cooking.